Hey, how are you? Vladimir Ribakov here from Traders Academy Club. In this video I would like to talk about one of the hottest subjects when it comes to real trend trading. I'm speaking about the hidden divergence. And in this video I would like to explain briefly what is the hidden divergence and what's its principles, and to share with you one of the trading strategies I apply when I trade with the hidden divergences. So let's start. First of all, hidden divergence is a trend continuing divergence, meaning once we spot a hidden divergence, we assume and we expect that the existing trend will continue. So if it's a bearish hidden divergence, we expect a bearish trend continuation. If it's a bullish hidden divergence, we expect a bullish trend continuation. Now, any oscillator could be acceptable here for a usage of the hidden divergence purposes. I personally prefer to use the histogram of the MACD. Therefore, in the video, you would see me using the MACD, or the MACD as traders love to call it, with its default settings. So what does the hidden divergence tell us? The possible continuation of ongoing trend. How do I identify that? How do we work with that? Let's see some charts and not waste the time. So this is an example of a bearish hidden divergence. How do we spot that? By the definition, a bearish trend is a trend where the highs are going down. Also the lows are going down, but mainly the highs begin to go lower, like steps, right? And that's a place where a hidden divergence normally is spotted. How do we spot that? Lower highs on the chart. We are looking on the histogram of the MACD, as you can see on the indicator below, and it will show you exactly the opposite, meaning higher highs. So lower highs on the chart, higher highs on the indicator. In a bullish hidden divergence, meaning in a bullish trend, the first definition for a bullish trend, it's the lows are going higher, like steps, right? When you go upside. So same here, the lows are going higher. The second low is higher than the first low. At the same time, by checking the histogram, you would see exactly the opposite signs, meaning the second low would be below the first low. So higher lows on the chart, lower lows on the indicator. To remember that easier, I prepared such a diagram for you when this would be easier for you to remember. So remember, higher lows on the chart, lower lows on the indicator. This is for bullish hidden divergence, expecting a bullish trend to continue. Bearish hidden divergence, we are watching for lower highs on the chart, while we will see higher highs on the indicator. So the first thing and the most popular mistake that not experienced traders do, or traders who are very excited with the subject of the divergences, what they do is they see something that look like a hidden divergence and they say time to trade. And what do I mean? Looking on this downtrend, they will spot that a hidden divergence starts much earlier than this official top, right? So if you take a look on this area, right, and draw a line, you would see that right here the MACD already is higher than the MACD here. So we do have lower highs at that point and higher highs on the histogram at that point. But is that good enough for us to go and to celebrate a hidden divergence? The answer is no. You do not call a divergence as it builds, or the divergence becomes official mainly when it ticks, or at least as it is confirmed on the lower time frame, and I will explain that in 1 minute. So don't be super excited when you see something that reminds a hidden divergence and say, this is it, my trend is going to continue. There are two main factors when it comes to hidden divergence: perfect trading, classical, correct, professional trading with hidden divergence, and I will mention them in 1 minute. But before, I would like to invite you and encourage you to subscribe to the channel if you are new to the channel. Just click on the button subscribe, and remember, there's a bell there. Make it enable that so you can get notifications when my videos uploaded to the channel. If you enjoy my work and like the video, please leave your comment below in the comment section. Hit the like button, and you can feel free to share with any of your friends who you believe could have benefit by watching this video. As well, I would like to invite you to our completely free Telegram channel where we share trading ideas, educational materials, videos, and much more. To do so, just follow the link in the description below the video. So, let's continue. The trading strategy, one of the main trading strategies I apply when there is a hidden divergence spotted, is the one I'm going to show right now. So the first thing we do is we identify the hidden divergence. The second thing, we make sure there are no opposite signs on the higher time frame. Why? As I mentioned before, the hidden divergence is a trend continuation divergence, meaning if you want your trend to keep developing, the higher time frames should support you and not have signs against you, meaning to give you a free road for a trend. Make sense? And once you spot that, you go to one lower time frame and you want to make sure you get a basic divergence in the direction of the hidden divergence you want to trade. Why do we need a confirmation on the lower time frame? The answer is very simple. Hidden divergence comes after trend correction, right? And at the end of this correction, we expect the trend to continue. Now, if you think about it this way, this correction is a corrective cycle, right? Corrective inner trend, short-term trend against the main trend, right? And if it's going as a short-term against, you want this short-term to end. How does trends end? With basic type of divergences. Okay? Of course, if you want to learn much more about the divergences, I invite you to enjoy the videos I have in the channel. Also, to check around with the Divergence University for full divergence education. So that's what we do in the hidden divergence trading. And the main factor here, the main thing here is this. If number 2 and 3 are missing, we skip the trade or we put X on this trade, okay? Now the time frames, to remember that easy, that's how we work with. If we spot a hidden divergence on the 1 hour chart, the verification lower time frame will be 15 minutes and the higher time frame to make sure the roads are free without obstacles will be the 4 hour chart, okay? So remember this table, it will help you when you work with the hidden divergence. Now let's take a look on the chart. So here's the example. The daily chart spots in a bearish trend lower highs, right? We also have the lower lows, classical definition for a bearish trend. At the same time, we compare these highs on the MACD and you figure out that the highs on the MACD are going up. Lower highs on the chart, higher highs on the histogram indicator of the MACD. Voila, we have a bearish hidden divergence. We have two things to do. First of all, go left and check, verify that higher time frame is not against us. And when we check the higher time frames, the last divergence there is bearish, basic divergence. So a bearish trend develops. And at that very moment, we have no obstacles against us. Free road to continue. We go to the lower time frame to verify that the trend is ready to continue and the correction is ending. How does the correction end? With a basic type of divergence, the divergence that shows reverse. So we are checking on the MACD. We see that voila, while the highs are going up on the price, here the highs are going down. Classical basic type of divergence. And we know that the trend is very likely to continue. Now there are many variations to enter the trade as an entry strategy. Many traders use different approaches and it's more than okay. The first and the most important thing begins with the definition. I use any of these three possibilities for entry, the break of the most recent low, of course on the lower time frame, right? The 4-hour chart with this basic divergence. This would be the conservative. This would be the moderate. Entry would be with the most recent trend line, where we can spot a divergence. And more aggressive approach would be to attack false breakouts. And you can see right here, it starts with divergence, fake breakout, but this one would fail, right? With making one more high, the next fake breakout with the next divergence would pay. An amazing movement. So that would be the aggressive approach. Of course, the most conservative approach would give you maybe less in terms of risk reward, but a conservative definition by breaking the low. Moderate, as it sounds, and aggressive would be more aggressive with bigger chance to maybe have more frequent losses if the first attempt fails, but much bigger risk reward to pay all the way, plus on the next ones it pays. What is the best for you? We all are different. Some traders prefer the aggressive approach and they have no problems with having series of small losses as long as they get a big paycheck. Other guys prefer the conservative approach. It's totally fine, whatever works for you. Now there could be many different approaches here, like the moving average crosses, whatever it is, Fibonacci levels, anything. The first thing starts with the definition. When you define the hidden divergence correctly and you verify it correctly, you have better chances to be right. And that's the hidden divergence at its best. Thank you very much for watching this video. I hope you enjoyed that. This is one of the strategies I use for hidden divergence. If you would like to see more, I invite you to explore my channel, to join us in the totally free Telegram channel right below in the description link. You can follow me in my live trading rooms on daily basis in Traders Academy Club. Thank you for your time. I wish you wonderful trading, and I'll see you soon in the channel with more videos. Bye for now.